afternoon. It's Dustin with Highway 1 Capital on Tuesday, April 7th, right at noon. Stocks are down today across the board, and oil is up to $112 a barrel. Most of you are following as strikes on Iran continue and the Strait of Hormuz remains effectively closed. It's clearly too early for market watchers to stop thinking about this, the geopolitical risk. And Trump has implemented a hard 8 p.m. deadline tonight for Iran to make a deal or else suffer dire consequences. So far, Iran's rejected U.S. peace proposals, causing tensions to run high, to say the least. The next 24 hours are going to be really important for us to follow. We're certainly hoping for a resolution soon, both as a concern for humanity, but also in order to calm the markets. As Tim and I have discussed before, but clearly worth repeating, history shows stocks often recover quickly from wars and other military engagements, especially when economies are resilient and when earnings fundamentals remain strong. We've been talking a lot about valuations over the last several months. We actually are starting to see some improved valuations. The benefit of stock market declines is that it gives investors an opportunity to buy stocks at lower valuations, assuming that earnings hold up. And that's what appears to have happened. Since the conflict began the last day of February, the S&P's dropped about 4.5%, and the consensus for the S&P earnings has actually increased about 2.5% for 2026, from roughly $310 to $317. Tim and I aren't in any way suggesting that equities are cheap, but when the Middle East calms down, we'll see an opportunity for a higher PE ratio. We still have normal levels of volatility. I know it seems like they're high, but it's within the normal range, and that suggests that the risk reward backdrop for stocks is getting more favorable. However, we clearly haven't seen capitulation signals flashing. We haven't had this washout of selling, nor do we have any additional clarity on how the Strait of Hormuz opens up. But for now, we believe, as we have for since the start of this, that the best course of action for most investors is to stay patient and stay diversified. On the interest rate side, we see interest rates continue to be elevated. That is clearly expected based on all the uncertainty that we just talked about and how elevated oil prices could impact inflation. Everyone's still looking for the severity of this and also the duration of the increase in energy cost. The 10-year Treasury still remains within our forecasted target range. As Tim mentioned last week, it's currently right about 4.3%, and between 4.3 and 4.35. There's been a lot of talk lately on private credit and the potential for this to create the next economic disaster. We're seeing some forecasts that it's going to be worse than 2008. We don't take that lightly. We are monitoring the credit markets very closely, as we've been updating you every week. We got an update this morning from Lord Abbott on credit, their outlook on credit and fixed income, and no dire outlook there. Data from Cliffwater suggests that the default rates with the secured lending sector is about 5% right now. Historically, we're around 2.5%. So defaults are elevated, but not nearly at the level where we're in a dire situation. But clearly, a lot of the defaults are stemming in the software space. And one of the challenges with private credit is leverage and illiquidity. So we clearly have to keep our eye on that. And we're not making light of the potential risk there at all. But credit, similar to equities, in that the longer the conflict drags on and the longer oil prices remain elevated, the more problems will arise. So once again, we're clearly hoping for a quicker resolution to this. Diversification remains key for most investors for now, but we think opportunities will open up at some point. Thank you all very much for your support and your confidence in us, and we're wishing everyone a wonderful week. Thank you.